Welcome. This is the Lifetime Cashflow through Real Estate Investing podcast. This is where you'll learn strategies to help you achieve lifetime financial freedom through real estate investment. Your host, Riyad Khleif, has owned over 2,000 homes and apartments, and he brings experts in all aspects of real estate investment and management onto the show. Now, here's your host, Riyad Khleif.
Welcome to Lifetime Cashflow through Real Estate Investing. I'm Riyad Khleif, and I'm thrilled you're here. Before we get started, I just want to mention one thing, guys. If you like what you hear, hit the subscribe button. That way you never miss another show. And, one other actually quick thing, and those of you that don't know that are new to the show, I also do a small segment every week called Your Driving Force Success Tip. It's where I share with you the most valuable things I've learned over the years about the psychology of success. And most people don't realize that 80% of success in anything is your psychology. 20% is the actual, learning, the mechanics of it. So I hope you'll join us on those shows. I think you'll really get value. So let's get this party started. I know you're going to get incredible value from the guy we're talking to today. His name's Mark Walker. He's a successful real estate investor. He's got just under 100 units, worth over $4 million. He started out in residential and got into multifamily, and we're going to ask him all about that, why he did it. And Mark, thanks for being on the show, brother.
Hey, Rod, I am really thrilled to be here.
Awesome. Well, so I gave you a very short introduction because I really want to hear it really from your mouth as to how you got started. I'm excited to hear that you got started in Denver because many of you know that's where I got started. So let's hear what Mark's all about.
Yeah, so Rod, I started out, I'm just, your typical everyday Joe. I started by my first investment property in 2004. It was a duplex in South Denver. At the time, I was working full-time for a high-tech company. And, I think I started out like a lot of people, do. I read the book Rich Dad, Poor Dad by Robert Kiyosaki. And, he just gave me this itch, this passion for real estate. And, I bought that first deal, and the cash-on-cash return on that first property was 36.5% in the first year. And when you're getting a return like that, boy, you get excited. And, that was the beginning for me. And it wasn't, so then I owned that property for a couple of years and ended up selling it and sitting the next few years out. It was a very different market.
So we're talking about your regrets now? Are we talking about your regrets now, or are we talking about, oh, no, it was the market conditions? All right, fair enough.
Yeah, absolutely. It was the market conditions. If I'd known then what I know now, I believe that, great opportunities come along all the time, regardless of whether the market's hot or cold or whatever,
That's why I was giving you a hard time with the regret thing, because everybody I ever interview says, when they stop buying or waited too long to buy, it's always a regret. So anyway, sorry I interrupted you, buddy.
No, and I can relate to that, actually. Yeah. I completely agree with that. But it turned out to be a blessing in disguise, because then, we all know what happened with the market. And then
sure.
in the 2010 time frame, I started networking again, and I met a general contractor, and we decided to do a couple development deals together in, trendy areas of Denver that were getting a lot of investment, Highlands and the Berkeley areas. So I did a couple of deals with him where we actually scraped single-family homes.
Oh,
and
wow.
Then we, raised up a 3-story resident, duplex in its place. And then we sold off each side. And,
awesome.
Those were,
awesome.
It was a lot of fun. It was a great experience, made some good, returns on my money. And, but development deals are a lot of fun. But the problem with development deals is you tie up your money for 12 to 15 months at a time, and it's not like multifamily, right, where, you can renovate a property and still rent out, a huge percentage of the units and get income off the property while you're renovating it.
Absolutely, and it's a lot more work. What you just described is a lot more work. I guess it's dear to my heart because I know those areas so well, and I can just imagine what you did there. But, I hear you, and so you realize there's an easier way.
I sure did, and so that kind of started my journey, for investing for cash flow again. In 2011, I had all this capital come out of these these development deals, and I started buying rental properties. And I bought quite a few residential properties between 2011 and 2014. And I'll tell you, I would not touch any property that didn't cash flow 20% or greater in the first year. And I was finding those deals. So I acquired quite a few residential properties, and then in 2013, I bought my very first larger multifamily property. It was a 12-unit apartment complex.
Where at, by the way?
So that was in Aurora.
Okay.
And it was over by where the medical center is.
Peoria or Havana.
Recent. Yeah. That area is getting a lot of investments.
Okay. Yeah, that's right.
Yeah, absolutely. And so, that was kind of my intro to, doing larger multifamily deals. And I'll tell you what, Rod, I had a strategy, a plan, an exit strategy to hold that property for 10 years. And about a year and 3 months into that deal, someone came along completely unsolicited, and I ended up selling that property for around the same price of where I was expecting to exit in year 10. So it was just an opportunity I couldn't pass up. And so I took that money, I 1031 exchanged it, and I bought a 64-unit apartment complex in Irving, Texas.
Wow.
And I closed that transaction in December of 2015.
Congratulations.
And thank you very, very much. It was really a huge stepping stone investment for me as well, because, I'd been on this journey. I'd started in residential, just progressed and did, bigger and bigger deals as I went. But this was my first deal where I was able to get agency debt. And as you know, Rod, you can get some pretty attractive terms with agency debt, non-recourse loans.
So you put non-recourse debt on this property?
I did. I put a Fannie Mae small balance loan on it. I was able to get 80% loan to cost, a year of interest only, 30-year amortization. It's a fantastic loan. So what is this, a B property, A property? What caliber of property would you say this is? It's a C+ property. And this is a 1960s vintage property, so it's always going to be a C. It's in a great area in Irving, and it appeals to working class families, and the property has a great sense of community. It's been a great investment. I completed the renovation with the exception of I'm still renovating units as the leases turn. But everything now is renting up well above where my pro forma was. So I'm pretty pleased with this investment. And
if you don't mind, I'd like to break it down. Let's break it down. Soup to nuts. Do you mind doing that? All right. Let's start from the beginning. How'd you find it?
Well, I found it. This property had actually been on the market for about 9 months, and the listing got stale. I think we see this more often than we think. You have a seller that goes in and has this idea in their head of what they want to sell a property for, and they get several offers and they turn them down, because they wanted more. Well, this owner went through that process over the course of 9 months. He received several offers, and I stepped in about 9 months in and was able to scoop it up. So
how much was he asking? How much was he asking initially, and what was the cap rate, and then what did you end up getting it for?
He was asking a little over $2.8 million. I ended up picking it up for about $2.6.
Okay.
Now, at the time, the in-place cap rate was probably around 7%. Okay. But what I projected is that in the first year, I would give my investors 11% cash-on-cash return. And if I modeled it out on a 5-year hold and forecasted that I'd be able to give my investors a high 20% IRR.
Okay. That's great. Let's back into the deal a little further. So you had to raise 20% of $2.6 million, or what, $520,000 plus. How much extra did you raise on top of that for your renovations and operating costs?
Yeah, my total capitalization was $631,000. That included the down payment, the closing costs, funding my operating account up front, everything. And what's also great is that the Fannie Mae, the small balance loan product, allowed me to get an 80% loan to cost. So I set aside $325,000 in CapEx at closing to renovate the property, and I was able to roll that into my loan as well.
Yeah. Wow.
Yeah.
Hold on, guys. I want you guys to understand what he just said, okay? So basically, they gave you a 80% loan to cost, but they included your capital expenditure escrow into the cost. So you paid 2.6, but they based the 80% on 2.9, if that's what I'm hearing, correct?
Yep, and I'll add one more layer to that.
Okay, but hold on. I want you guys to hear that. So basically, he didn't get an 80% loan. You got about an 80. Hang on, I don't know what it works out to, but it's better than 80%. So, which is really hard. And the other thing, and the reason why I asked you if it was an A or B property, because you got a year's worth of interest only, which I didn't think they did that on C properties. So that's fantastic as well, because guys, when you're paying interest only, your cash flow is exponentially higher that first year. So the returns to your investors are higher that first year. So you got them to roll in the CapEx. What's the other thing you were about to mention?
They also gave me 3% for soft costs. So I was able to take some of the closing costs, my legal,
third-party reports, all that stuff. Okay, so yeah. An additional 3% on top of the CapEx amount, and then they calculated the 80% loan to cost.
That's right.
Okay, so guys, what's happened here is, typically you got to put 20% down. In this case, he really didn't, because they rolled in the capitalization costs on top of the loan, and they rolled in 3% in soft costs. Soft costs are anything from loan fees to third-party reports, getting your appraisal, getting your phase 1 environmental report, and all the reports you need to get these loans like this. Wow, fantastic job on that, Mark. That sounds like a great deal, and you really got into that thing in an enhanced, reduced equity position. So let's that's awesome. What kind of rate did you get, by the way?
Well, the rate was a little higher. I ended up locking at 5.14%. And unfortunately, when I closed on this in December of 2015, that was right when the Fed was threatening to start raising rates again.
So they bumped up a little.
They did. They bumped up a little bit at the tail end of last year, and now they've come back down, into like the mid fours, for that type of loan. So. But it's okay.
Don't beat yourself up, buddy. We used to think we died and gone to heaven when we got 7%. So listen, the days of 4 and 5% aren't going to be around forever. I would not cry over a 5% loan any day. So, and
you know what? One other thing I'll throw out there too is that, when it did lock at that, I wasn't too concerned because, in my underwriting, I did, some, I actually, stretched it. I actually ran scenarios to say, well, what if I stress tested it, we call it,
Sure.
What if the rate was higher? And so, would I have loved the rate to be more, mid fours? Absolutely. But, it didn't stress me out, on the day we rate locked, because I had planned for that scenario.
Right. And by the way, guys, what he just said, stress testing, is something the banks will do as well. They'll look at, what happens if this happens? What happens if your vacancy drops? Or, increases? What happens if your cap rate expands? They're gonna look at things like that, because they're going to evaluate your debt coverage ratio with a stress analysis. And the debt coverage ratio, of course, is your ability to cover the debt. It's a ratio that translates and allows the bank to see that there's enough net operating income to cover the debt. But So let me ask you this: how'd you raise the money? How did you have an investor database? Did you go out and network? How did you raise the money?
I went out and networked.
Okay.
And
can you be more specific? Where'd you go? What'd you do?
Yeah. I'll even back up and maybe even just kind of stress the importance of networking, in my opinion, too, because I'll tell you what. When you look at my journey, there has been so much that has, fruit that has come, there's been bared as a result of some of the networking I did even 5 years ago.
Sure.
My lender in this case, invited me to a Broncos breakfast. Every year we go over to Mile High Stadium, which is where the Broncos play. And we have a breakfast, and Dave Logan speaks at that event, and you meet other customers of the bank that are obviously very like-minded people. And I met a guy that we ended up sitting at the table together, and he just was kind of intrigued with what I was saying about multifamily, and we ended up getting together for coffee a few times, and when this opportunity popped up, we decided to do the deal together. So, and it's been a great relationship. So
you did it all with one equity partner.
Yeah, I brought one other guy in too that brought $50,000, but the aside from myself, the majority of the money came from this one individual that I met at that breakfast.
Well, good for you. So, guys, you can see how easy this can be. You don't necessarily have to have 30 investors to take down a deal like this. If you catch the right guy and you're out there all the time talking about what it is you do with passion, and you've learned the business, so you can be congruent, and then you'll have confidence, you'll have the ability to influence. Well, good job on that, Mark. So
thank you.
Let's talk about property management. I'm a big advocate for self-managing, but having a property in Irving might be a little challenging when you live in Colorado. How did you find your property manager there? How did you handle that component?
Well, I'll tell you, this is a little bit of an unfair answer. I have a cousin that's been 30 years in the business, multifamily.
Okay.
And he owns a multifamily investment company with a property management division. And they've operated in, the Dallas-Fort Worth market for quite some time. So, I had that unfair advantage. But one thing I will say about picking a property manager is you've got to be able to separate the wimps from the winners when it comes to property management.
Well, talk about that specifically then.
Yeah, when I obviously have a property management company in Denver as well, but
Sure. One
thing I always tell myself when I'm, talking to property management companies is you got to keep in mind, you're not just hiring someone that is going to, go off and, find you a tenant. You're essentially, and you're not just hiring a person, you're buying into all of their systems as well. Everything from the systems that they have in place for dealing with people that don't pay their rent to the property management software that they use. You've got to be able to interface with that software and extract the information, that you need to run your business as well. So that's something I'm always reminding myself is you're not just hiring a property management person, you're buying into all of their systems. So I spend a great deal of time.
Now, this is the software guy talking.
That's right. I did come from high tech. That's
guy. No, there's no question that you need to be able to analyze whatever it is they give you, and if you're utilizing their systems, if they've got property, if they're a large firm, they're going to have a big software system, and I would say, you just have to know what reports you want, and they have to be able to dice and slice them any way that you need. But, unless you're going to actually have them linked to your system, I think, is that what you're talking about, actually linking to your own database?
Well, I'll tell you, in the case of my residential properties in Denver, just because I have so many,
right.
I do link to my bookkeeping system. So yeah, I have done that in that scenario. But in the case of my multifamily property in Denver, that's a completely different management system. And but yeah, I mean, to answer your question, yes. I mean, it just depends on you and what you're going to need. But it's not just the software, too. You know, there are management companies that have better systems in place for dealing with other things, like what do they do when someone doesn't pay their rent? You know,
I see. You're talking about business model systems. Got it. I thought you were talking about software systems entirely. No, you absolutely have to ask those questions. You know, what happens when they don't pay? What happens when this happens at 12 o'clock at night? You know, what do you do if you have a $1,000 repair? How many bids do you get? Do you call me if it's just a $100 repair? You know, what happens when the vacancy drops below X%? You know, how often are you guys on the property? You know, is there somebody there full time? All of those questions need to be asked. And you did get lucky, obviously, having somebody in the family that you respect and trust to do that. So let's move on. Did you use a sponsor to buy that property, or did you take it down in, you know, primarily your name?
I took it down myself. You know, I was actually the sponsor on that.
Okay.
However, you know, you're onto something, Rod, that I think is important, right? Because, you know, looking back, you mentioned regrets early on, right? I don't know that I'd call this necessarily a regret, but maybe something that I would have done differently.
Okay,
you know,
hey, let me stop you for 1 second. For those of you that are new, that don't know what a sponsor is, it's if you're going to take down a larger property, and you're going to go borrow money like Mark did here, they're going to want to see some track record. Not only are they going to want to see some track record, they're going to want to see some financial strength. And you know, they're going to want to know what's in your bank account. They're going to look you over. They're going to look at your income, and they're going to look at your experience. And so it's very common for someone that's buying their first larger property like Mark did here to bring in a sponsor, someone that hopefully already owns something similar to what it is you're buying, or you know, has some serious financial strength. And so it's not uncommon. And for those of you that want to get into these larger properties, that's why you need to go network and meet mentors that, you know, that are involved in this space and develop relationships, because it's okay to give away a piece of your first or second deal, and bring in a sponsor like this. Like we're talking about, because it will it will accelerate your ability to buy properties. So anyway, so those of you who didn't know what a sponsor is, that's what a sponsor is. You bring them in, they're a partner in the deal. You know, they can play as large or as small a role as possible. I brought in sponsors where all they did on the Fannie Mae debt like this was they signed on what's called the bad boy clause. And they did that on a mobile home park, but they basically, whenever you buy non-recourse debt, there's nobody on the hook for the loan, but somebody has to sign that says there was no fraud, and that's called the bad boy clause. And you may need to bring in a sponsor to do that, you know, to sign, and that's typically all they're really acknowledging, and they get a piece of the deal. It doesn't have to be a big piece. If they put money in, obviously it's a bigger piece. So anyway, I wanted to explain what a sponsor was. So go ahead and continue with your point on it.
Yeah, great explanation, and you know that's, you know, looking at my journey, I started out in residential, and I bought a whole bunch of residential properties, and then I bought a smaller multifamily property, about 12 units, and you know I gradually just started doing bigger and bigger deals. Now you can do that, you know, it's a great
strategy, right?
It is, you know, I to your point, you know, Rod, I built the, you know, financial strength during that process. I started to build a track record and gain experience, you know, that the lenders love to see. And, you know, but the thing is that took me some time. Looking in the rearview mirror, I could have accelerated my path in multifamily, you know, doing these bigger and bigger deals if I would have attached myself to a sponsor earlier on. And you know, you need to do it for maybe your first one or two deals, you know, but when you basically jump on their, you know, you piggyback on them, you basically bring their experience and their financial strength and everything that the lenders are looking for along with you. And once you've done one or, you know, two deals with a sponsor, and you've built that track record, and that financial strength, then the lenders will look to you to stand on your own. So that's a way that I could have shortcut my path into multifamily if I wanted to.
No question. And any of you guys listening can do the same thing. There will be people in your local markets. I personally sponsor deals. I'm sure, Mark, you do as well. You would consider doing it if the deal was right. And there are guys out there that it's very, I mean, it's a win-win all the way around. If you bring somebody a deal and it's a real deal and they can get a piece of it just for being involved and they can do their own analysis to see it's a great deal, why wouldn't they get into it for a percentage of it? So, and you accelerate your track record, because as soon as you take that down, even if you've got a small percentage of it, you have taken down an apartment building and it's on your resume forever. So, use that as a tool. So are you looking in other markets now? Are you trying to identify another property and maybe do a syndication again?
Yeah, I definitely am. I'm still looking in Texas. Okay. Colorado is really a really hot market right now for sellers, which is great because I still own a lot of properties here.
Right.
But I'm still able to find deals in Texas. So I finished up the renovation on the 64 unit. Now I'm starting to get a little bored. My wife wants to kick me out of the house. I need to find something to do. So I'm definitely looking for that next deal, and I'll probably end up syndicating it.
Oh, that's super. So, all right, what advice? There's a lot of people listening that have not done any deals at all, and maybe some that have just done maybe a duplex or something. What advice would you give a newer investor, that wants to break into this space?
Well, in addition to accelerating your path by attaching yourself to a sponsor, I'd just say, and this goes for anybody, I've always just had the philosophy, never stop learning. Learning leads to action, and action leads to success. Learning leads to action. A lot of times, especially when it comes to real estate, people don't want to invest, or they hold off, or like you said earlier in the show, right? They never get started, right? Because they're intimidated. They're intimidated by the thought of taking risk or losing money and things like that. But the more that you learn, the more comfortable you're going to become with your strategy. And there's a lot of ways to make money in real estate. Multifamily, I think, is one of the best ways. I'm a little biased there, but
the
more you learn about it, the more comfortable you're going to become, and you're going to end up feeling more comfortable, which eventually leads to action. And you know what? If you sit back and you don't ever take any action, you've failed before you've even begun, right? So you've got to take action, and as you take action, you're going to continue to learn. You're going to tweak your strategy and your process, and it's going to lead to absolute success. So, I give that advice to everybody, whether it be for real estate or anything else.
Absolutely. Is there a book that you like or any books that you like about multifamily investing, or a resource that you can talk about? I know you've offered to also leave a report, and guys, he's going to give us a web link.
Yeah, if you go to www.luxmana.com/lifetime cashflow, I'm going to make this paper available for free to you guys, just as a thank you for listening. I've basically consolidated some of the lessons that I've taken away during my journey in this guide. I call it 10 not so obvious ways to boost your multifamily property NOI. And these are things that are less obvious. This isn't just like, hey, go raise your rents.
Right.
This is about actually extracting value and some of the more creative ways to do that. So, thank you guys for listening, and I definitely want to make that available. Again, it's luxmana.com. That's luxmana.com/lifetime cashflow.
Yeah, and it'll be in the show notes, guys. If you're driving, don't have the ability to write it down. So, a couple last questions. So, what inspires you? Is there? Do you have anybody you look up to? Do you have any mentors?
Oh, I have several mentors.
Okay.
Yeah, absolutely. And I think that's so important. Rod, I'll just use you as an example. Thanks so much for doing this show. There's
sure.
many of us, regardless of where we are in our journey, I tune into your podcast and, many others as well, because I'm still learning. I'm constantly learning and finding new ways to, maximize the returns on my investments and other areas where you can make money in real estate. So, I have a lot of mentors, that are in the business. My cousin being one of them as well. I'm fortunate to have had a mentor, a family member that's been in the business for, 3 decades. So
sure.
Sure. That's so important.
Back to my question about books. Any books that you like? Obviously Kiyosaki stuff, but anything multifamily or real estate related specifically that you might suggest?
I haven't read any, books specifically just about multifamily, but like you said, I do like.
How about anything, motivational or self-improvement related? Yeah,
Arbor Commercial has a great, blog that they post some great information on. I enjoy, reading that blog.
Okay.
I also enjoy Kevin Bupp's podcast.
Oh yeah,
as well.
Kevin's one of my greatest friends. Just FYI, he lives up here in Tampa. Kevin's focusing on mobile home parks, and we do mobile home parks as well. But no, Kevin is truly one of my greatest friends. I actually spoke to him yesterday. Well, listen, you've added a lot of value today, Mark. I really appreciate you taking the time to be on the show. Let's leave my listeners with one last little bit of advice. What, they want to get into real estate. What would you tell them to do?
Yeah, I'd just say never stop learning. Just remember, guys, that, learning leads to action, and action leads to success.
Thank you for being on the show, and we'll stay in touch.
Sounds great. Thank you so much, Rod.
You bet. Take care. Bye now.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please subscribe and then take a moment to visit iTunes and leave a 5-star rating and review. For more resources to connect with us further, please visit our website at lifetimecashflowpodcast.com. Tune in next week for our next show.